Hello, everyone. Today on the Final Bar, my guest is Chris Vermeulen from the technicaltraders.com. We'll talk about a couple of key charts that he's paying attention to, how they're in a period of fluctuation, I would say. We've talked about this environment being a digestion phase or maybe even an indigestion phase, as we have a lot of rotation, leadership themes. The last couple of days, particularly this week, feeling a little more like a risk-on versus risk-off play. As I've talked with some of my guests this week, it's leaning more risk-off. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets themselves provide. We focus on trend and momentum. We focus on whether charts are in uptrends or downtrends. We focus on quantifying trends, following those trends, and then using a set of technical tools to anticipate or to identify trend exhaustion. And when we're looking at the market environment now on days like today, when you have a bit of a give back in the equity indexes, you have defensive sectors at the top of the list. That leads me to think a lot about the risk management side. I think as a technical analyst early on, you're taught to think about risk versus return. As a trader, as an investor, you need to think along those lines as well. There are times when it seems like you should be thinking about potential returns. There are times when you should be thinking about potential risk. And I would say, arguably, given the rotational environment that we've had, given the weakening breadth characteristics and some of the challenging readings from breadth indicators and other risk-off indicators, maybe the time to think a lot more about the risk side of the equation, about the downside potential, and how to protect yourself effectively. Now, we have fantastic guests on the show, as always. I'm excited to talk to Chris Vermeulen here in a short while. Coming up next week, we have Dale Pinkert on July 20th on Tuesday from Forex Analytics. On Wednesday, Ari Wald from Oppenheimer. On Thursday, the 22nd, Jonathan Krinsky from Baycrest Partners. Excited to get their take on everything going on in their own charting work. Also, as a reminder, this whole week on Stock Charts TV, it is our special event, Charting the Second Half. This is our focus on the mid-year market outlook, how the first 6 months have played out, what is coming here in the remainder of the year. Some fantastic presentations so far. People like Martin Pring, Linda Raschke, Tony Dwyer, Gina Martin-Adams. We just recorded a panel today with JC Peretz, Jay Woods, and John Kosar. It's going to be a lot of fun and so many great ideas to help prepare you for the second half of the year. Go to stockcharts.com/charting, the 2ND half, charting the second half, for the full schedule and all the great content for that event. Let's continue on today with our market recap. So as I mentioned, the S&P in a bit of give back mode. This has been the discussion we've had, I think, for most days this week. In previous weeks, it had been the S&P going higher, mega caps sort of pushing higher. Some of the more cyclical sectors, the small caps, struggling a little bit. Today's sort of one of those days when everything's kind of rolling over a little bit, but not everything. If we look at the defensive side of the coin, things like utilities, things like consumer staples, holding up there just fine. But the weight pushing the S&P down about 1/3% to close around 4360, down from yesterday's close. Small caps continuing to underperform, so underperforming by about 20 basis points, down just over 0.5%. And the NASDAQ 100 actually leading the way lower, 0.7%. Technology, actually one of the worst S&P sectors. Not a lot of times I feel like I've been saying that recently, so certainly feeling a bit of a mean reversion there, move to the downside, with the NASDAQ coming off of all-time highs, of course. The VIX right around 17 today. 10-year yield coming down. We're actually ticking just below 1.3%. And you saw that bounce earlier this week, coming back up after it touched the 120s. We're kind of right back there, reverting lower. And that lower yield environment, lower interest rate environment, certainly weighing on something like financials, which actually ended up today about 1/3%. But overall, it is tough for the financial sector to outperform when you have interest rates going lower, right? When you have a lower rate environment. We're going to dig a little deeper into the financial sector later in today's show, talk about some of the key charts and key themes in a sector with a lot of companies reporting earnings this week. The dollar index back a little bit higher with the UUP nearing 25. On the commodity side, you had sort of a mixed bag, with energy actually the worst of the S&P sectors, and oil prices down today. Gold actually started lower and then finished the end of the day about flat after recovering through much of the course of the day. Cryptocurrencies continue their onward trajectory to the downside overall. We've talked about the risk on charts like Bitcoin overall, the distributive patterns that we've highlighted in a little more detail recently, continuing to push to the downside overall, with Bitcoin down around 31,600. Let's focus on the chart of the S&P 500, then we'll touch on some of the other themes here to continue our market recap. So, this chart is one that we've been referring to often on the show. This is the daily chart of the S&P that I review every morning. And the trend line, I would argue that has been the key to define this trend, is connecting the October low with the March low. You can see that lines up very, very well with the May low. Lines up very well, I would argue, with the June low, in that we broke below it for one day and then closed right back above that trend line. We touched that again about a week ago, and today once again touched this trend line. So, the way that trend lines work, and when all is said and all else being equal, is the more you touch a trend line, the more you confirm that sort of trajectory. It's a way of just visually defining the trend, and it's a great way to understand when the trend is changing, right? The trend line continues to be in place, but when that stops being the case, when this trend line does not hold the most recent pullback, that's when you have to start to consider that the trajectory is adjusting a little bit. So today, trading right down to that trend line, I think is very, very important. Through tomorrow into next week, the question is, do we bounce off of this trend line like we have many times so far? Do we continue to push lower? If we do, the 50-day moving average is absolutely, I would argue, the key line in the sand to pay attention to. The 50-day moving average has served as support many, many times year to date, all successfully, with the market reverting back to the upside every time it tests that. I would look to see if that's able to hold. Now, the thing is, there's a difference between the short-term trend and the long-term trend. The short-term trend can go lower. We can have a pullback in the 4 to 6% range. That would take us right around to this sort of level, the 50-day moving average, maybe down to around 4170, which would be the swing lows from June. That would still arguably be within the context of an uptrend. We start breaking those levels, I would say most importantly, we break something like 4050, which would be the low from May. Then all of a sudden the chart starts to look very different, right? You have a pattern of accumulation changing to a pattern of distribution, making lower lows and lower highs. And that's where you have to start really thinking about the potential for further downside. But 4050 is quite a ways away from where we are at the moment. Just to wrap up our market recap, and then we'll take a quick break. Again, on the sector side, very much a defensive feel to today, but not completely. You had utilities, number one, consumer staples, number two, and we've talked about the underwhelming relative characteristics of the consumer staples sector. But I would argue, I mean, if you picked any one of those sectors randomly, I bet I could find a couple charts that are holding up there just fine. And in staples, things like Costco and others come to mind that are in pretty decent uptrends. So there are opportunities around. You just have to know where to find them. And I would encourage you to use things like the scooter rankings to order things based on their trends, find some of the opportunities you may not have otherwise found. Very interesting after that, though, to see financials and industrials both in the positive list for today and outperforming the S&P. On the downside, energy really dragging lower, and we're going to go there here in a moment, followed by technology, communication services. So the FANG stuff, the FANMAG stocks, the stocks that have been the leadership, sort of dragging down a little bit today, and that's what's causing some weight in that part of the market. Let's look at energy very quickly. Well, we have got about a minute or two left before we take a break. When we're looking at some of these cyclical sectors, the challenge I always think of is a chart in accumulation mode or distribution mode. And I use those adjectives often, and it's very much a non-scientific way of characterizing a chart. When you look at a chart, what is your first impression? Is this chart in an uptrend or downtrend? There are a lot of very systematic, very consistent ways to try to define that. But for me, it's just a shorthand of, is the trend going up or down? And for me, it starts with the very basics, the Charles Dow version of trend analysis. Are the highs getting higher? Are the highs getting low, or the highs getting lower? Are the lows getting higher? Are the lows getting lower? And by looking at that, you can get a sense of the trend. What concerns me on the chart of the XLE right now is you've gone through sort of this classic reversal pattern where you've made new highs, and really energy, financials, others made new highs May into June. Then you can see all of a sudden a lower high, and now potentially we're making a lower low, especially on the tactical time frame. On that short-term time frame, looking at the last month or two, you can see that rotation from an uptrend, a sector making new highs, to a downtrend, the sector undercutting its previous lows, now breaking below the 50-day moving average this week, testing it from below, and now reverting back to the downside today. So downtrends begin like this. However, actionable pullbacks tend to look a very, very similar way. You can see with the move that we've had, it's very similar to the move we had March, April, May. My question for this sort of chart is, do we have a similar sort of pullback? We broke just below the 50-day moving average. We undercut the previous lows. You can see the trend line I drew back here in April saying, uh-oh, this could actually get a lot worse because we're really starting to show distribution. That was the end. That was the end of that pullback before we reverted higher. So I would argue things like the XLE, things like financials, which we'll talk about in a little more detail, at really pivotal points. And the question is, are they able to hold some of these support levels? Are they able to minimize this sort of pullback phase before reverting to the upside? Because you're very close to the chart starting to look like there could be much more further downside potential. The XLF looking a little different. And within the financial sector, I would argue you've got a bit of a dispersion in terms of what the charts kind of look like. You have stocks like MCO and others, which we'll talk about, that are in pretty good uptrends. You have others that are like JP Morgan, for example, that are really threatening to break down and give sort of a head and shoulders sort of pattern. The XLF, very similar to the XLE. These are two sectors that have broken below their 50-day moving averages. They're now testing the 50-day moving average from below. Getting back above that 50-day, starting to put in higher lows would be the indication that that pullback phase may be over. But I think at this point, it's still an open question that has yet to be answered. We need to take a quick commercial break. We'll be back with my guest, Chris Vermeulen. We'll see you in a minute. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. A couple quick announcements before we get to our guest, Chris Vermeulen. Number one, if you have questions for us, we love to hear from you. Questions about charting, about technical analysis, about particular charts, particular tickers, ratios, investor sentiment, psychology, whatever it is, we're here to help point you in the right direction. Our email is thefinalbar@stockcharts.com. We're on YouTube. We are on Twitter. We're on Twitter at FinalBarSCTV. On our YouTube channels, put a comment below the video that you're watching. We would love to hear your questions. We'll gather some of those and hope to answer one of your questions in our next mailbag segment on Friday's show of this week. Also, go to StockChartsTV.com, use your email, set up a free account. You can start watching all of our fantastic content, our great shows like The Final Bar and others, fantastic guests like Chris Vermeulen, sharing their expertise, all on demand on our website, StockChartsTV.com. Also on your mobile devices, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Chris Vermeulen. Chris is the founder of thetechnicaltraders.com, coming to us from the Toronto area. Chris, always a pleasure to have you on. You always bring a couple charts that help us think about the overall environment. Welcome back.
Yeah, thanks for having me, David. Always a pleasure.
So as I was describing the market recap portion earlier in the show, Chris, it was sort of this, I called it a digestion phase or an indigestion phase, sort of this rotational, what's working, what isn't. We're starting with, an asset class that I think has given a lot of investors, a lot of traders, a bit of indigestion, cryptocurrencies that have reverted from a significant uptrend to now giving a lot of those gains back. Start us there. What are you seeing?
Sure. Well, I think we can all pretty much agree that Bitcoin has been in a bubble phase over the last year and a half. If you look at the monthly chart, it's pretty much a hockey stick pattern where it goes straight up and takes off. But when we zoom into this daily chart right here, you can see that Bitcoin lost some of its momentum. Back in April, it had a really strong sell-off and it broke two previous pivot lows, those two horizontal red lines there. And so the way I see the market from a technical standpoint is when you break two pivot lows, you've had enough downward momentum to break two support levels. That momentum is now shifted. And then price went into this sideways, very weak kind of bear flag pattern, and it really struggled to get above the 20-day. It was hanging on to that 50-day, but eventually, whichever way it was going to break, above 60,000 or break down below that bear flag, it was going to have, I think, a pretty big move. And the bias was to the downside at that point. And we did end up seeing that big collapse. Now it fell over a 2-week window there, about 54%. Now, when you look back at Bitcoin over, since 2010, it's actually had 6 of these massive bubbles. And each time on average, it's corrected about 74%. So we still have some more downside to go just to have an average Bitcoin correction. So there is more downside. I think we could potentially see 22,000 or 23,000 on Bitcoin. And there is potential for one of those washout capitulation lows down to around 12,000. It would be probably an intraday washout, an absolute complete annihilation like we saw in May on that big long wick. It would probably be one of those where everyone panics and then it rebounds very quickly. And that's the way Bitcoin moves. It's volatile, it's fast. This is normal for it. You see this in stocks though, and it'll make your, it'll definitely shake some nerves. But when we look at this pattern, the thing here is what the key point is. The trend went from an uptrend, higher highs and higher lows, as you talked about, David, and then it had a break, and then it started making lower highs and then broke to lower lows, and it's clearly in a downtrend. So that's kind of the main gist. Now, the second chart that I actually have there is the XLF, which you just talked about, and it actually has a very similar type of chart pattern over the past 6-8 months. We've kind of broken 2 previous support levels. Price is now struggling at that 20 and 50 day with a bearish pattern, a bear flag pattern. And if we were to get a break to the downside, then we're going to see about an 8% haircut in the stock market. And what really scares me is that financials have had some good earnings and they are completely underperforming. The energy sector is starting to break down. These are both pretty big sectors. And if they're breaking down and not showing signs of, they're showing signs of weakness, that's not good because energy and financials kind of look forward about what the economic outlook looks like going forward. So this is where I'm confused or I'm nervous about which way are we going to see the financials break. And the stock market to me is very close to having a much bigger correction. It hasn't broken down yet. SP 500 continues to kind of grind its way up, the NASDAQ leading the way, but they are primed and ready for a 5 to 10, maybe even a 15% correction in the stock indexes. And I think we're going to get some insight here what financials do. And I didn't have the chart here, but the Russell 2000 has been putting in a very big consolidation pattern for the last 5-6 months. It looks like it could be a major top. If it breaks to the downside, that is going to be further confirmation that there's a lot of money coming out of the risky plays and people are going defensive. And we are definitely seeing all those things. The market internals are very weak. Bonds are starting to outperform stocks. Utilities are doing well. Precious metals are starting to hold up. All the signs are there that we're about to have a big correction, but you don't want to go picking a top. You want to wait for confirmation. You'll never get out at the top. You wait for the breakdown, then you close positions, then you can take advantage of the downside, however you want to do that. So that's how I look at the market. Those are the 2 kind of really critical charts to give you an idea of kind of what I'm looking at going forward.
We only have about a minute left, Chris. You touched on so many great themes there. I really appreciate your perspective. If what you're describing is correct, if you do see financial sort of continue this breakdown that appears it could be doing, during earnings week, when if there was a catalyst to make the banks go higher, I feel like we're there, and so far not really materializing. What do you do given that potential environment? Is this the time to double down on sort of the mega cap tech that at times has been defensive in pullbacks? Is it to get defensive and go full REITs and utilities, or is it look elsewhere, things like gold or things like that? How would you be thinking about protecting from the potential downside?
Yeah, it's tough. I mean, I don't, the stock market trend based on my analysis is still up. So I'm still long sectors. I'm still long individual stocks, but until the indexes give me a sell signal, I'm going to stay long. I think we're potentially 2-3 days away from the markets giving me a technical move to cash or a sell signal. Depending on how the market rolls over, I could end up moving into bonds. Bonds like the TLT would actually be my preferred choice. Very conservative. It's finally starting to become a safe haven play. It's starting to outperform. It's put in a bottoming formation over the last couple of months, and it's broken to the upside. So I think bonds is actually kind of the safest play here. I think there's about 7.5% upside in bonds. You look here in the financials, about 7.5% to the downside, 8%. So to me, when I do get a sell signal in equities, I would liquidate those and I would move to bonds because they are acting as a safe haven. And I think there's still quite a bit of upside potential in that area.
It's been quite a while since the stock to bond ratio has been favoring bonds, but you're absolutely right. We're sort of there. Chris Vermeulen, thank you so much for joining us. Take care, stay safe, be well. We'll talk to you again soon.
Thanks, David. Take care.
That's Chris Vermeulen. Chris is the founder of thetechnicaltraders.com. I love how he laid out the relationship between all these things. And he hit on a lot of the themes that we've been talking about, sort of the underwhelming breadth characteristics. But what I love about some of his comments were just laying out some of the potential scenarios. What would happen if financials break down? And then where do you look, right? Where do you sort of look for opportunities? It's a really good point. It's amazing that we're in a moment where people are recommending bonds, and it's not that bad of an idea. That has been a tough play for quite a while, but I think the charts arguably very much justifying it. Great take from Chris Vermeulen today. Let's continue on with our next segment called Sector Deep Dive. What we like to do occasionally is focus on a particular sector, focus on a particular theme, and dig into the charts a little bit deeper. We're going to stick here with the financial sector, and mainly because of the earnings. This week, sort of accelerating into earnings season. Every week, we're going to have a lot of stocks to unpack and to think about. In the last couple of days, we've tried to hit on some of the charts of the names that are reporting and what's happening to them. But with the financial sector, I think it's a really good time to sort of take a step back. What we're going to do today is start with one of the charts, if I can find it. Actually, I'm not sure if I can here. Let's start with the chart of the XLF. This is actually this one right here. We'll actually build it together. So this is the financial sector of the XLF. And as we talked about, I think Chris did a great job of sort of outlining the bear case. And what he was describing, if you caught it, was this is sort of a bear flag pattern. If you don't know what a bear flag really represents, this is the quick version. You have a down move, right? An initial thrust to the downside. Then you have sort of this short-term contrary move, counter trend move of higher highs and higher lows against the longer-term trend. The kicker is when you break a trend line using these lows, you take the low from mid-June and the low from last week. If we would break that trend line, that would complete sort of this bear flag pattern, right? A sell-off, the parallel, return back to the upside, and then you break down. And the idea is you would have a consistent move. So the move that you had leading into the pattern is probably going to be similar to the move you would have coming out of that pattern. That's where he got, I'm assuming, the 8% or so downside objective that he was giving on the financial sector, which, to be honest, is not that far off. I think JP Morgan's probably already down around 6 or 7% from all-time highs. So that's not that far away, but it's going to feel pretty bad compared to the limited pullbacks that we've had so far in the markets here today. Now, at the bottom, we have the relative strength of the financial sector, and we've seen the acceleration to the upside into the first week in June. And then look at how the relative strength went from making a new 12-month relative high to all of a sudden being in a downtrend. And that takes us to where we're at today. Now, what is actually causing that? Well, there are a lot of things, right? There are a lot of things that we could point to, but one of the things, obviously, is 10-year yield. So if we put $TNX at the bottom here, so we have the relative strength. We now have the TNX, and sorry, these are all the same color, so that's going to be a little crazy to try to highlight. There we go. It's in blue. We can see that the relative strength in the financial sector looks a lot like the 10-year yield, right? And this makes sense, right? In general, banks make money on the shape of the yield curve. So they can borrow at the low end, they can lend out at the high end of the yield curve, and that's the slope of the yield curve, and that's why that's how you're able to make a business borrowing and lending. So if you look, though, the 10-year yield has actually led the relative performance of the banks. If you look, you had an early warning sign sort of in the early summer into the fall from the TNX when yields started to improve. You can see that soon after, about a month or two later, the relative strength of financials also started to increase, and that kind of went in there. Here at the top so far in the relative forms, you can see that the end of March was actually the high watermark for the relative strength of the financial sector. From there, the relative performance is actually, the 10-year yield has actually been going down. So financials made a new high in May, even though yields were actually coming down. They actually made the peak of 175, and here they touched around 170 before continuing lower. So keeping an eye on the yield curve, I would argue, is a really good way to make sense of what's happening with the relative strength of financials. The question you have to ask yourself is, have yields bottomed out? And so far, what's happened is yields have rotated higher, and then you get the financial sector outperforming. We have not seen a bottom in yields, I don't think yet, at least from a technical perspective. You're not seeing any sort of change in the trend. The last thing we'll add on here, and then we'll try to look at a couple stocks before we have to wrap up, is BPFINA, which is the bullish percent index for the financial sector. And this is basically, I'm building one of the charts we looked at yesterday in the 3 and 3. If you look right now, 55% of the financial sector stocks within the S&P 500 are in a bullish point and figure configuration. About a month and a half ago here in, 2 months ago here in early May, it was almost 100%. It was about 95% of the S&P members in the financial sector in a bullish signal. So a full 40% of the financial stocks in the S&P have gone from a bullish point and figure chart to a bearish point and figure chart. They have broken down and given a sell signal. That is not a constructive pattern. So you see rates coming down as the bullish percent index coming down, indicating certainly a string of underperformance, which has been the case. My question would be, do we continue to see lower rates? Do we continue to see the bullish percent index go lower for the financial sector? This is the chart I would watch to get a read on financials. We only have a moment left, so I just want to hit on a couple key charts, and I will tell you there are charts within the financial sector. Remember, it's not just banks, it's not just JP Morgan and Goldman and others. There are a lot of different diverse businesses in there. You have specialty finance things, index providers, things like S&P and others that are in here. You also have insurance companies, life insurance, multi-line insurance, property casualty insurance, all represented in the financial sector. So I would look at the Scooter rankings. You'll see there are plenty of stocks in the top decile in the financial sector. Moody's comes to mind when I'm trying to think of a stock in a good uptrend in the financial sector. MCO is what usually comes to mind. My guest earlier this week, Larry Tensorelli, mentioned American Express, same idea, 94th percentile in a strong upward trend. There are charts within the financial sector that are still in classic uptrends of higher highs and higher lows. When you're thinking from a sector allocation perspective, though, you have to face charts like JP Morgan. We'll have to leave it here, but I would say we have the potential of creating quite a head and shoulders top pattern here that really isn't valid until you break the neckline. So you take a trend line, taking the April low and the June low, you'd have to break that to signal a real rotation lower. But if you do, that actually measures a lot lower, lines up pretty well with the downside objective that Chris was mentioning on the chart of the XLF. That's our sector deep dive looking at the financial sector. Again, I think for financials, it's all about the yield curve. It's all about the 10-year yield. Look at $TNX. But also remember, there are charts that are holding up just fine. Use the Scooter rankings to identify those. We need to wrap the show. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the NASDAQ 100. I talked with Chris about financials. We talked about Bitcoin. He mentioned briefly the fact that technology had rolled over. Technology stocks coming off today, and the NASDAQ 100 coming out of the overbought region. The NASDAQ has been overbought since the fourth quarter of June. From there, it's starting to, it's been overbought, just coming out of that overbought region. And while that on its own does not guarantee a big pullback, that's what a pullback would look like just before it starts coming off significantly. So worth noting that the NASDAQ had been overbought, no longer overbought as of today. Chart number 2 is gold. It's an interesting chart. I think the bullish momentum divergence that you saw there at the end of June is potentially really significant, right? And when you have lower lows in price, higher lows in momentum, I think the bond markets gave such a great signal here. If you look at the TLT or the AG, you'll see a very similar signal in recent months before bond prices have started to appreciate with the 10-year yield coming out of that the 170s down to where they are now. We're seeing a similar pattern now with gold. Right now, it's all about moving average resistance. Is it able to eclipse those on the GLD right around 171 to 172? Chart number 3 is Morgan Stanley. I mentioned in our deep dive on the financial sector, looking at interest rates, looking at the leadership stocks that have done well, stocks with the high Scooter rankings, but also mega cap banks like JP Morgan and others, which are a little more tentative in their uptrends, testing potential support levels. Morgan Stanley's another reporting earnings this week. And again, not really breaking down. So a lot of these have not really broken down yet to the point that you should start to get concerned. But on a chart like this, I think it's innocent until proven guilty. You have clear levels in play with the 50-day moving average, which has served as support many times. The swing low is around 84 or so from June that I would pay attention to. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Chris Vermeulen from thetechnicaltraders.com joining us from Toronto. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.